Okay, I think we're there. Yes. Welcome to our first YouTube Live on a lovely Tuesday evening. You may hear in the background my son does his piano lessons on Tuesday night. So there will be little moments of interlude that you might hear some beautiful playing. I did not hire a pianist to be the background for our YouTube Live. But I am super excited. We've got a lot of fun stuff to talk about tonight, and want to make sure you all know what we are covering. So we have got, we're going to talk about the economy. And before you think about what that is exactly that we're going to talk about, it's not just like numbers that we're going to talk about. It is going to be, what are the numbers that we need to look at? What are the numbers that we need to consider? What is good? What is bad? We hear all this talk about the economy, and I know I went to film school. I did not really learn what are the economic numbers that matter. And that's been one of the most the greatest things about getting into real estate is really understanding the economy and what that looks like. So we're going to talk about the economy. We're going to talk about the housing market, what is happening in Middle Tennessee, and what is going on in Middle Tennessee. And then I'm also going to share with you one of my favorite restaurants in Nashville, because a lot of times on this channel, I talk about food, I talk about real estate, I talk about things you need to know. And we're going to cover all three of those this evening. So I have got the chat up. If you have questions along the way, I am happy to to answer questions live while we're going. Or I've got some questions that has already been submitted on what exactly is going on here. And I am super excited to jump in with all of you and talk about, what do you need to know about the economy? What do you need to know about the Middle Tennessee housing market in March or, over the last year? And then one of my great restaurants. One of the things I'll say, I plan to talk about this about a month ago, and I did not know we were going to be doing this right after the tariffs were announced and all the stock market. So let me cover things we're also not going to talk about. I can do another comment on tariffs if you would like, but tonight we're not going to cover tariffs. We're not going to talk about the stock market. We're really just trying to get an overarching look at the economy so that you can know when you're hearing the news or, someone you follow on Instagram or here on YouTube, when they say this number about the economy, what does it mean? Is it good? Is it bad? What do I need to know about it? So that is what we are going to jump into right now. So we have a lot of data. Oh, also, I'm not a financial person. This is not financial advice. I am not an economist. I study the economic numbers and I've learned a lot about it, but this is not me telling you what to do with your stocks or what to do with any financial things. This is my opinion about how to listen to the economy that I've learned from other people. So let's jump in. There are three things that you need to know about in the economy. When they talk about, is the economy good? Is the economy bad? There are three key things. GDP, which is gross domestic product. You can see that as number one. Number two is the unemployment. And then number three is inflation. We're also going to talk about personal savings rate and economic risks and things like that. But I just want you to have those three things. So that's where we're going to start. Number one, GDP. Now, here's what you need to know about GDP. GDP, the target, like where you want this number to be, is somewhere around 2 to 3 is strong GDP. You can notice that those numbers have been pretty consistent, barring, I'm sure you can see in 20 and in 21, the fact that was COVID. So nobody bought anything. GDP is the gross domestic product that is being purchased by other countries or within the country. Like it's what the country is producing as far as goods that are being sold. So last year, you can see on these graphs, this goes back to 1990. So you can see there were moments where it was higher. There was moments when it was lower. You've got the Great Recession in 2007, 2008, 2009. Like obviously GDP fell then. Then we got back to a good, nice level just cruising along. Then COVID, of course, dropped it down. And this is where we've been. We way over, like way compensated for COVID in 21, then it fell to 1.9, then it's been 2.5, 2.8. It's in a good range for the economy. So when you hear GDP, that's the numbers that you want to be thinking about. So that's GDP. Number 2 is unemployment. Unemployment. So this is the number of people that are employed, or the percentage of people, who are unemployed. So it's the opposite. Now, here is your target number for unemployment. Somewhere between 4 to 5% of unemployment is a healthy economy. So again, we can look at this giant graph that has all these numbers and say, when was the economy good on employment? When was it bad on unemployment? And where are we right now? So hard right, that pink bar is last year. So it's 4. So it's right on target. 22, 23, 3.6 is below the target. It's basically full employment right there. So that was when you couldn't find somebody to get hired because everybody had a job and they were moving. And that's when it falls like that, that's when your wages are going to go up and, different things like that. But between 4 and 5 is a healthy economy. So last year we hit right at a healthy economy. Unemployment numbers still looking good. In 2024, I have no idea what's going to happen in 2025, but for right now, no matter what happens in 2025, the target numbers. The target is between 4.0 and 5.0. Nice, healthy, good unemployment. Only when it goes above that do we have a problem in the economy in that avenue. So that's unemployment numbers. Now let's go to number 3, inflation. This may actually be a number that you understand and you know what the target is because we've been talking about it in the news forever. So your unemployment target is 2%. A healthy economy has an inflation rate of 2%. Prices should be increasing, but they should only be increasing at a rate of 2%. You can look at this giant graph and see after 2020, inflation spiked between 2020 and 2021 up to that 7%. We all lived through that. We all knew that did not feel good. So we know 7 is not the target. But we have been trying to get back down. And by we, I mean the United States, trying to get back down to that target of 2%. Now, so in 2024, we ended up at 2.9% or 3.2, depending on if you're including energy and food or excluding energy and food. But either way, we are kind of at that. We're not at 2 for sure. Now, the target at the end of last year that everybody was looking towards thinking that this year would bring is closer to the 2.1 to 2.2 range. Now, we have no idea if that's actually going to work because of everything that's happening in the economy. And I have no idea. I do not know enough to tell you that. But what I want you to understand is 2% is the target. So if inflation can stay around 2%, that is a healthy economy. So 2% in inflation, somewhere between 4 and 5% in unemployment, and then GDP around that same 2-3% target. Those are all of the quote unquote healthy markets. Now, I wanted to focus on one graph about, I think personal savings is what we're going to talk about next and why that matters. But before I get into that one, economic risks. Great. Let's talk about that first. So we've got some unknown things. We're living in the middle of them right now. So number 1, unpredictable policy. Trades, immigration, regulation, spending, all of that stuff. Nobody is really sure how that all is going to shake out. But that's one thing. Number 2 is natural disasters. We continue to have every couple of years a really devastating situation at some point at some part of our country. And that is creating issues with insurance companies and just a lot of uncertainty that creates economic risk. And then you've, of course, got the international conflicts. All of those play into what could affect the economy and, put the economy in the United States at risk. So want to make sure you understand that as well. Um, but here's the thing about the personal savings rate that I wanted to share with you, because I think this is so fascinating. We're on the precipice of who knows what. Maybe the economy is going to bounce back. Maybe we're going to have that soft landing and inflation that they've been talking about. Maybe it's all going to work out. Maybe it's not. Who knows? But this is what I want you to understand about what's going on with your neighbor or yourself or, the people in your life. So this is the national personal savings rate. Now, this chart goes all the way back to 1959, which feels like a completely different era for sure. But you can see that dashed line in the yellow is the savings rate for since the beginning of this graph, since 1959. The personal savings rate, people putting their money away and saving, was 8.3% historically over time. You can automatically see that this graph has gone down over the last, right in there in the 90s and the aughts. Like, we took a nosedive in our savings down to 2.5% in 2005. We kind of got back through the Great Recession, decided, you know what's good? A cushion, savings, having some money to fall back on. And so we started saving again, got back up to that average, and then dropped off again. Now, it's been volatile through COVID. You're saving money because you didn't know exactly what was happening in COVID. Then you were spending it because you'd survived COVID. But where we are right now in 2024, it was 3.8%. So a good economy, and people are only saving 3.8% of their earnings. Why that matters is in an economic downturn, we are not prepared. We are not prepared to weather it because we're not saving enough money right now. We're not keeping our money. We may be spending it a little bit more. Maybe we're supporting the GDP. But from a personal savings rate, we are below even the average since like 2000. Since 2000, the average was 5.2% of your money was getting saved. And now it's 3.8. And so it's just, your neighbor may be a little bit more in jeopardy if the economy goes down. You may be a little more in jeopardy. And so I think that's interesting to notice and to watch from an economic standpoint on what is the economy actually doing and how does it matter. Now, the other thing that I want to talk about before we jump to like the housing market in Middle Tennessee and what do the economic numbers really mean for that, there is something that I am only just now learning about that I have heard, which is stagflation. I'm not sure if you have heard of that term before, but stagflation is kind of the opposite of the soft landing that the economists were going for with all these interest rates going up and things like that. So stagflation is when the GDP falls, unemployment rises, and inflation rises. It's basically everything goes in the wrong direction. We're not making and selling enough product. There's not enough jobs for people, and everything costs more because that's inflation, making making goods cost more. So goods cost more, we buy less, and less people have jobs. That's what stagflation is, just in case you've heard that term and are wondering. So GDP would fall below 2%, unemployment would go above 5%, and inflation would stay above 2%. So that's what you might be hearing if you're hearing somebody talk about stagflation. So that is kind of a Eco 101, I guess. I've never actually taken that class, so I'm not exactly sure. But this is what I watch, what I needed to know to really understand the news and the people that are talking and, what can we learn and hear from the people who are reporting, because they may have their own agenda about creating fear or creating excitement about something. And I want you to know what numbers matter and what the targets are that you are always going to be looking for. So that is our quick economic lesson. Now let's jump into, we sell houses. This is our economy, the economy of houses, and what needs what you need to know about that. So number one, we'll talk about home sales. We'll talk about home prices. We'll look at this nationally, and then we're going to also kind of zoom in on Middle Tennessee and Williamson and Davidson County and mortgage rates, things like that. So let's start with home sales. In 2024, we had one of the lowest years of number of homes that have sold. So what that means, look at the pink bar, just like all these graphs have been, the pink bar was last year, 4.1, I think it's million, 4.1 million, million homes sold in the United States. This is United States data. If you look back across, that dashed line shows you that, since 1996, more homes have sold in any year except for 2008, which was the beginning of the Great Recession. So we have had less homes sell. Now, another economic lesson, supply and demand. Demand has diminished a little bit, but there is this thing about supply that determines price. So less homes have sold in the United States since, like, in the last 28 years. I don't know how to do the math really quick on that, but something like the last 28 years. 2024 was the least amount of homes that have sold. Now, it's not going to be bad news about pricing because there is less supply. So because the supply is low, even though the demand is low, prices are still holding steady. But I just want you to know that's what's happening. And the forecast for 2025 is not that we're going to have a big boom of home sales. This is driven by a chart we'll see later about interest rates. But it's not going to get worse is the projection, and pricing continues to increase. Now, we looked at this number specifically in Middle Tennessee, and I was wondering, how does it flow along with the national numbers? So we kind of charted the home sales national numbers for you. So this is the national numbers, that chart we just saw, but in a line graph. Now, we're going to layer on top of that what's happening in Davidson County and what's happening in Williamson County. We are not selling 6 million homes or 5 million homes in Middle Tennessee. We're just looking at what is the direction of the graph. So let's start with Davidson County. We have seen a little bit of a decline in homes selling in Davidson County, like same thing as the national average. You can see right there that they chart together on the decline for sure. But if you look back at 2013 and 14 and 15, remember when Nashville became the it city, we outperformed in the number of homes that sold in Davidson County right there. Yeah, we crossed the national numbers. We no longer were running right with the national numbers. We surpassed it. So even though our trend line is running down, we're still, above where the national numbers are for that. Now, let's look at Williamson County. Williamson County, we've layered on here. There's one thing that is really interesting to me about that. Williamson County trending just like Davidson County, surpasses the national numbers and how many, the percentage of growth of home sales over there. But there's one little thing at the end of this chart that I think is so fascinating. And at the end, Williamson County is still continuing to increase. You see that little spike up to the right, while Davidson County is kind of going straight, maybe just a little bit of a decline. We're seeing an increase in Williamson County. So they're up almost 3% over 2023 to, 2 years ago, year over year numbers. So great news in Williamson County is we've already maybe started to recover in Williamson County for the number of homes sold. Now let's jump to housing prices, because this is the question we get all the time from clients. Like, what is going to happen with prices? We've had people who, unfortunately, it just kills me. They decided, you know what? I think this is a bubble after 2020, 2021. They sold their house and they're like, we're going to buy whenever this bubble bursts. and they're never going to be able to afford to get back into their neighborhood now because of this chart right here. You can see from a national average standpoint, prices have gone beyond the trend line. This green line that you see is the 4% kind of expected appreciation of homes. If you look at the beginning in the 90s, this graph like totally trended with our 4% line. When you talk about real estate as an investment, often you're talking about a 4% increase in value every year. Well, you can see we got out of line in like the boom whenever the mortgages were not being responsible, and then we fell below the trend line and stayed there for over 10 years, slowly trending up at a 4% increase, but very much below the trend line. And then COVID shot us back up above the line. And this is what has people talking and saying, I wonder if it is a bubble. It's why people think it might have been a bubble. It's why those clients sold that house and didn't get back in the market. But here's the difference, because when you look at this graph, you could look and say, man, this is just like 2005 and 6, and people lost their homes, and it was the Great Recession, and people, banks were foreclosing on everybody. This is just a horrible time. But the reality is, as far as how far out of line we are not that far out of line of the trend line. Back in 2006, prices were 21% above that line. If you look at today, or 2024, what happened last year, we're only 10% above the trend line. Now, that's still above the trend line, but the reality is supply is still low. So even though demand is low, we're not seeing a huge drop off. We're not seeing a ton of foreclosure opportunities. We're not even seeing a ton of people behind on their mortgage. So home prices are expected to stay pretty consistent. In Middle Tennessee specifically, we've got kind of, a nice 3%, 2%, 4%, depending on where you're looking, increase in prices. So we're not even completely stagnant. We're not going down right now. There are markets that are, like Austin is seeing a huge drop in prices, but Nashville is staying, because we've got low supply and the demand is staying the same. Prices are increasing at a normal rate. The rate of pricing that we saw in 2021 and 2022, 2023, even the beginning of the year, that was like a 20% increase. That was crazy. That's not healthy. That's not sustainable. It does not make housing affordable. But a nice 3%, 4% increase is healthy and a safe market to be in. Now, here, though, is where it gets you've got to be really hyper local, because we've got 2 zip codes in Nashville right now that are acting completely different from each other as far as pricing goes. And this is because of supply and because of demand. So we've got 2 great zip codes in Nashville, 37215 and 37220. And one of them is going down in value year over year. And one of them is going up in value year over year. So 37215 in the March reports that I looked at has a price decrease of 10% year over year. Now, that could be because there were no $40 million houses that sold in 37215. I didn't dig into the data that much, but down 10% in 37215 and in 37220, which is it like Oak Hill area, up 11%. Grabs a pocket of Creve Hall and is Oak Hill. Their pricing is up 11% year over year, 2023 to 2024. And 37215, which is Green Hills, down 10%. So it's just interesting. And you can't just look at the averages. This is where real estate is very hyper local. And so you need to know, if you want to sell your house or if you want to value your house correctly, which area am I in? Or if you want to buy a house, which area am I in? How do I need to make the best offer? And you need to make sure you're looking at the data there specifically. So that is housing prices. Now, let's talk about inventory. So this is the supply and demand issue that I was talking about. The green dashed line that you see across this is a balanced 6 months of inventory market. Across the country, this is back to national numbers, we have been below average, and I would say 3 to 6 is where a balanced market is. Somewhere around the 6, maybe you want to hug 4 to 6, whatever floats your boat. But we have been in a dramatic seller's market for year after year after year. And we are just starting to inch back up towards what we would consider to be a balanced market, which is 6 months of inventory. We call it the absorption rate. And if the market could absorb all the inventory, how long would it take to do that? 6 months is kind of a balanced market. Again, our team sort of looks at 3 to 6 months as a balanced market. Anything less than 3 months is a seller's market. Anything above 6 months is a buyer's market. When I got into real estate in 2009, you can tell right there, nationally, it was 8.8 months of inventory. Very strong buyer's market. But that's not where we are right now. Now, when you look at the Nashville numbers, I want to make sure that you know what that is as well. In Williamson County, so here's what you need to know. It's all about price point. All about what price point you're in. Just like before, I said, all right, how much are prices changing, or how much, our prices changing neighborhood to neighborhood, it's different. Well, the same is true in Davidson County and Williamson County, just based on pricing. So if you are in Davidson County and you are in the lower price point, it is still a balanced market. In the low price point, it's obviously a seller's market still. But if you're below 1.25 million, it is a balanced market. It is a great time to be a buyer. It's a great time to be a seller. If you're over that $1.2 million purchase price in Davidson County, then it is a buyer's market, not a dramatic 8.8 months of inventory. Like, we're talking about just over the 6 month mark. In Williamson County, it is still a balanced market if you are over $2 million. It is a balanced market over $2 million. If you're under $2 million, it's a seller's market. So if you want to buy a house that's over $2 million, buyers have a little bit more power. And if you want to buy a house that is under $2 million, sellers have a lot of the power in Williamson County. So if you're in the market, that's what you need to know about how it feels in Middle Tennessee right now based on those economic numbers. All right. And that brings us to mortgage rates. What is driving the slower home sales is mortgage rates. Now, we have gotten used to pretty much mortgage rates in the 6%. 6.27% is where they were. Everybody's hoping they're going to go down into the 6.5s. They're teetering around the 7s. They're bouncing between 6.5 and 7. And nobody really knows where exactly they're going to land. But this is the slide about why home sales have slowed a little bit. But here's the thing to know about interest rates. If you look at these dashed lines, the average since 1972 is 7.72 interest rate. The average is not what we experienced for the last decade before interest rates popped and inflation popped. 7.72 is the historical average for interest rates. 6.7, still below 7.7. So it's still a great time to buy. 6% is the average since 1990. And I remember when I bought my first house in 2003, which you can see on that graph right there, 6% was the interest rate. It just pops up there. Yep. And 6% is what I paid for my first house. So we're in the realm of people who have lived through interest rates that are the same. Did we love it when it was 2.75? Sure, but then that created the inflation stuff, and we've got to deal with it. And this is the only lever that the government can really pull to try to change inflation, is the cost of money. And so this is how we see this. So interest rates, 6.7. We're not expecting to see a dramatic decline. If inflation gets out of control again, it might go up again. Who knows? This is where I am not projecting. I am just reporting and making sure you know targets. So anything below 7.7 is a good interest rate. Anything below 6 is an amazing interest rate. But it's not a scary time to buy a house. It's still a balanced market. You can still get an affordable rate. If you can afford it, you should not be afraid to make a move, because there's nothing in the economy that is truly an out of control marker. And there's also no reason in the housing market, especially in Middle Tennessee, that would say not a great time to buy a house. Now, the last thing I want to talk to you about with interest rates is about where people are sitting right now with interest rates. So let's go to the pie graph, and yes. So 74% of people who have mortgages, of the mortgages, so not 74% of the houses, because there's people who own houses outright, but 74% of the mortgages have rates of 5% or less. This is only leading to less inventory. And remember, supply and demand, less inventory, less supply means prices continue to go up as long as there is demand that outpaces the inventory. And we have been outpacing the inventory for a very long time. And the more that people are sitting on their homes and are not putting them on the market because they're trying to keep up with these amazing interest rates, they want to save them. That's even less inventory. Those are people that would normally be moving. I mean, I know we've got a client right now who they want to move, but every time they see a house, they're like, oh my gosh, that's so expensive, and I've got this amazing interest rate. How can I ever make a move? Just take a deep breath and do it, because the prices are just going to go up. We can do a whole nother talk about that. But if you wait 2 years, and if you think about that pricing graph, prices have increased at such a rate that you're not going to save beyond what housing is increasing, even at 4%. I mean, think about it. The average person is only saving 3.5%, the personal savings rate, 3.5%. And if houses are increasing by 4%, you are net zero. You're not going to outsave the housing market right now if you're at average and the housing market at average. So I think that's enough numbers on a Tuesday night at 7:30 for you. So my promise of a good meal is where I will leave you. So one of my favorite restaurants, which if you're in Nashville, maybe from these photos, you know what it is. It has been my favorite restaurant for a long time. It had a hard few years after COVID, and it almost lost its place. But I've been back the last few years, and it is phenomenal. So that restaurant is Rolf and Daughters. It is up in Germantown. You can see on the map, and it's hard to get a reservation still, even though this restaurant has been around for, I mean, I think it's a decade. It might even be more than a decade, and it is still almost impossible to get a reservation. I usually go right when it opens and sit at the bar or sit at the community table, but they have the most inventive food. I got the which is basically like spaghetti bolognese last time I was there, but it was the most phenomenal thing. I made a joke to the waiter that, like, I can't come here and order the spaghetti. And he was like, trust me, you need to order the spaghetti. And they had made it with the tomato stem instead of, like, I don't even understand. But there is nothing that is not amazing that I get served there every time that I go. So if you've not been to Rolf and Daughters, make sure that you check that out. If you have any other questions about the economy, feel free to leave me a comments. I'm happy to answer those along the way or in one of our future videos. So thanks for coming on a Tuesday night. And you all now are equipped to know what is going on in the economy, what the numbers mean when you hear the news report, and don't be afraid of the real estate market. It's still a really great time to buy a house for the right price. See you later.